All right, welcome to The Explainer. Today, we're digging into a really chaotic day on Wall Street to understand the key forces that sent the markets tumbling. Okay, let's dive right in.
So here's the plan. We're going to start with the big picture, then unpack the three main drivers: geopolitics, some big tech troubles, and an energy crisis, before looking at what the experts think might happen next.
Okay, so first up, let's just take a look at the damage. And it was a tough day for investors pretty much across the board.
As you can see, all three major U.S. indexes ended the day deep in the red. The S&P 500, it hit its lowest close since September. But wow, it was the tech-heavy Nasdaq that really took the biggest hit, shedding nearly 2.5%.
Now, that nearly 2.5% drop in the Nasdaq, that's a big deal. Why? Because it officially pushed the index into what Wall Street calls a correction. That means it's now down more than 10% from its October high, and that, my friends, is a key technical level that signals some major investor anxiety. So where is all this anxiety coming from? Well, for the main driver, we really need to look at the escalating war with Iran, which was just hanging over the markets all day long.
And get this, just 11 minutes after the closing bell, President Trump announced an extension to a key deadline for potential military strikes. But here's the thing, that announcement came way too late to calm anybody down during the trading day. Instead, it was the looming threat of that original deadline that really drove so much of the selling. The delay just kicked the can down the road, prolonging the uncertainty.
And you can see the direct impact of that tension right here. Worries over the conflict sent the price of Brent crude oil just soaring, up over 5% during the day. A spike like that in something as crucial as oil, that sends ripples through the entire global economy. And believe me, it's not just about what you pay at the pump. This kind of uncertainty makes borrowing more expensive for basically everyone. We saw U.S. Treasury bonds sell off, and that in turn helped push the average rate for a 30-year mortgage up for the fourth week in a row. That puts a real chill on the spring housing market. But you know what? The war with Iran wasn't the only story driving the sell-off. At the exact same time, a totally separate storm was brewing over in the tech sector, and it was hitting some of the biggest, most influential names out there. So, first up, Meta. Their stock plunged nearly 8% after getting hit with back-to-back losses in court. And investors are now getting really nervous about a potential big tobacco moment. They're worried that a huge flood of lawsuits could lead to these massive, incredibly costly settlements, just like the ones the cigarette companies faced decades ago. And at the same time, a whole other scare was hitting the hardware side of tech. A new development from Google sent this shockwave through the companies that make one of the most critical components for AI, memory chips. So what did Google do? They unveiled this new algorithm that, to put it simply, lets AI models do more with less memory. And just the possibility that AI's crazy, insatiable demand for hardware might slow down, well, that was enough to send stocks like Micron and Western Digital tumbling more than 6%. But hold on, not everyone's buying the hype. Some analysts are pretty skeptical. Jordan Klein over at Mizuho points out that, look, this research isn't exactly brand new. And his take is, if it was so good and in wide-scale use at Google, trust me, they would not come out and publish a paper on it. He thinks the market might just be overreacting here. All right, let's pivot a little and zoom in on one specific part of the energy market. It's a great case study. We're talking about liquefied natural gas, or LNG, because it gives us a really fascinating snapshot of the current global mood.
So on the one hand, you've got the marketing, right? You have commercials pitching LNG as this cheap, super efficient energy solution. This quote here is from a recent ad for a major exporter, and it paints a very rosy picture.
But then, on the other hand, you have an actual industry CEO sounding the alarm. He's warning that these surging prices, which are being caused by the war knocking a huge producer like Qatar out of the market, are actually a major threat to the industry's own future.
So here's the ripple effect. This price crisis is literally forcing countries to find other options. Instead of getting locked into these super high-priced LNG contracts, Asian nations are actually burning more coal. Others are hitting the accelerator on their push toward renewables and nuclear. So, ironically, the high price of LNG is actually killing its own long-term demand. Okay, so when you put it all together, you've got geopolitics, you've got these specific tech fears, and this big energy shock. The big question for every investor out there is, what on earth does this all mean for the future? And, no surprise, the experts are split.
On one side, you have strategists like Tally-Legger, who argue this whole sell-off is just a big overreaction. They believe the U.S. is pretty well supplied with oil and that most of the bad news is already priced in. But on the other side, you've got Keith Lerner, who's advising a lot more caution. He's saying that, yeah, the market looks oversold, but it's just way too early to confidently say we've hit the bottom.
So, if we boil it all down, today's big market drop wasn't caused by just one thing. Not at all. It was a perfect storm. The combined weight of those geopolitical tensions from the war, the specific headwinds blowing against the tech sector, those broader energy price shocks, and of course, the economic uncertainty that ties it all together.
And that leaves us with one final thought. We've got another deadline now set for April 6th, and the market is really balanced on a knife's edge. And honestly, only time is going to tell if today's panic was just a brief overreaction or a sign of a lot more turbulence to come.